Welcome back. Well, one of the stocks of the last few days has been Apollo Hospitals because the company posted a weak set of Q3 results. The profits were well below street estimates, while Apollo Healthco is seeing its EBIT losses widen this quarter. And the key disappointment has been the sharp margin contraction that we've seen. Sunita Reddy, the managing director of Apollo Hospitals, joins us now to talk about that. Sunita, thanks for joining us as always on CNBC-TV18. This is Sonia here. I want to talk a little bit about the margin pressure that you're facing, primarily because of the EBIT losses that you've seen in Apollo Healthco, the retail as well as the diagnostic arm. I understand that the first few years of these, new ventures could perhaps lead in losses, so you'll have to bear with that. But can you tell us that could it get worse before it gets better in terms of the blended margins as well?
I think that's a very good question. I think we've reached a phase of peak losses, and in the process, in the first 3 years of digital, it's very important that we get volumes, and critical volumes are very important to scale the business. We have currently 25 million users, and we're doing over 45,000 transactions on the online business. And I think all of this comes at a cost. So we built up a whole new company, which is currently incurring losses. But if you were to deconstruct the revenues, so total consolidated revenues were at 4,264 crores, which represents a 19% growth year on year. And consolidated EBITDA was at 505 crores. But if you look at healthcare services, which is core business and a major part of our business, we had 2,194 crores of revenue, a growth of 9% year on year, and the EBITDA came down. The EBITDA was at 543 crores. So a healthy growth of 9% at a margin of 24.7%. So clearly the healthcare core business is doing very well. AHLL posted 311 crores of revenue and 25 crores of EBITDA. So the focus on the diagnostic business, with that yielding 1/3 of the income of AHLL, is very good for the company. The third, of course, you asked about Apollo Healthco, and we're seeing 84% growth quarter on quarter, which is good. And I think it is the fastest growing digital healthcare company.
No, the growth, of course, is what you're seeing on the top line, that I get. But you started by saying that you've reached a phase of peak losses. Is it fair to assume that this 100 crore loss that you've seen on Apollo Healthco, is this the worst that you've seen in terms of the digital business, or could it get worse over the next few quarters?
No, we don't anticipate it'll get worse over the next few quarters. I think that we have come to a position where we have reached peak losses. And, this year should be peak losses, and after that, it will start coming down. So you can expect to see that from April 1st of the next year, next fiscal year, our EBITDA will start coming in. And the losses will come.
Ma'am, good morning, Prashant here. Just to stay on that business, delay in the fundraise for Apollo Healthco and competitive intensity on 24/7 have been the key concerns for investors whenever we speak with analysts on Apollo Hospitals. Could you give us some way to think about this as we get into 2023? What should we expect on that front?
I think we should really calibrate our expectations. We should look at what is required short term and what is required long term. As we look at losses, I have said we've reached peak losses. I believe that there will be a requirement of 200 crores for the first half of next year. And this is something that the parent company can definitely fund. So for the short term, Apollo Hospitals' balance sheet is extremely strong. We have 1,130 crores of cash with us, plus a very low debt to equity of 0.34. So with this, we can easily fund the growth of Apollo Healthco. Having said that, we do have for the long term, we are talking to investors. They are not strategic in nature, but investors who are there for the long term. And I think that all of us know that the environment at this time is not the appropriate environment for capital raise. but we are working on a capital raise.
All right. But, okay, that's interesting. And you're absolutely right. I mean, of course, and it's an overall funding scene which is kind of pulled back a little bit. It's no longer the go-go market we were in. And that, of course, has implications for everyone. So if in your case, ma'am, what should we expect? I mean, pushed back into, you already indicated the parent has the balance sheet strength to fund Apollo Healthco in the near term. So should we expect something this year, towards the end of this year? Or should we look for this sometime next year? What's your sense? If you can leave us with some guidance, some timeline.
Let me say this, that if we were pushed into getting an investor in, we could probably do so in 3 months. But we believe that the valuation will only improve. They have done 543 crores of GMV. They're on track for 1,600 crores ahead of the information memorandum. And I think we should get the right valuation. So I think 6 months is a good timeline. I don't like to state timelines at this time, but
Yeah.
I have to say that we have investor interest.
No, we do understand that. I mean, it's been delayed for a while now, so I guess it's better to just leave the timelines out of the way until you get more clarity. But you said that you're on track for 1,600 crores of GMV in FY23, and that's what you had guided for earlier, I think 1,500 crores. Are you also looking to meet that guidance of 3,000 crores GMV in FY24? Because that's doubling of the GMV. Are you on track, or do you think you could even exceed that?
I think, let me be conservative and say we're on track. Quarter-on-quarter growth was 84%. So there is a very healthy trajectory.
Okay. Also, since you've mentioned that you don't anticipate more losses in the digital business, at least not higher than this, in terms of overall margin performance, what do you think you can do? I mean, will you be able to get above this 11-12% band, or do you think you could hover around it, say, in FY24? What's the margin projection on a blended basis?
On a blended basis, I think healthcare services will continue to improve. And since that contributes to a major part of the business, I think you will see 100 basis points improvement in the blended margin, and most of it coming from healthcare services. Having said that, the back end of AHLL, which is the offline pharmacy delivery, has delivered an EBITDA margin of 7.4. Having opened 500 stores, I think that this margin coming from back end will continue to grow and will really contribute to an increase in blended margins.
Okay. So 100 basis points improvement in blended margins is what you're looking at from these levels, correct? That's by the end of FY23.
No, I think we'll do much better. By the end of FY23, yes. But next year, I think you will see a huge ramp up coming from margins.
All right. All right, fair enough. Ma'am, thank you very much. Appreciate you joining in, and great chat as always. Thank you very much for joining us here on CNBC-TV18. Thanks indeed. Well, Borosil Renewables is the next company we're speaking with, again on the back of earnings, but the third quarter earnings set has been a bit muted. Margins have come in sharply lower at 26% compared to 45% last year. It is also important to note that while solar glass demand stayed strong, it was met by rising imports, which perhaps has hit sales here for local manufacturers. Pradeep Kheruka is chairman of Borosil Renewables. He's joining us now. Mr. Kheruka, it's always a pleasure having you with us here to put things into context for us and our viewers. Let's just start with that number. Things have been a bit muted, in the third quarter. Is our rising imports the main reason? What's the demand situation? What did the demand situation look like in Q3, and what is it looking like now?
The demand situation continues to be very strong, and the reason for the rising imports is because after we have sold everything that we possibly could, the country still needs more glass, and that is why they have been importing glass. The other thing, of course, which has played a role in the lower EBITDA margins, the percentage, is that there was an anti-dumping duty which was levied on imports of glass from China, which has been withdrawn or which has lapsed in August. and the full effect of that has now become visible in the shape of lower prices for us. Meanwhile, there has been an increase in the cost of inputs, which we saw in the year 2022. And both of these put together have contributed to the lower, the still very healthy EBITDA margin, but lower than what it was in the previous year, where we were looking at a situation of shortage. So, of course, that was an exceptional situation. There were very high freight rates coming in from China. The freight rates have dropped significantly. They're nearly now what they were pre-pandemic. So it's the prices are probably as competitive as they're going to get in terms of import.
Okay, all right. Good morning, Mr. Kheruka. Always good to speak to you, sir. Let's talk about the expansion that was coming on stream. The SG3, I think so, the furnace was likely to get commissioned. Has that got commissioned in the past quarter?
Yes, indeed, it has. We were able to commission our third furnace, 550 tons per day on the 26th of January, which besides being India's Republic Day, was also Vasant Panchami, and also coincidentally, the 13th anniversary of the first day that the company stepped into solar glass. That was on the 26th of January, 2010. So we celebrated 3 anniversaries with that, and I'm happy to say that the results are promising. We are still measuring our paces. We are going through the paces. It's a very large installation. Unlike normal glass plant where you just have, you're done with after you've produced the glass. Here we are processing as well. 100% of the glass is ground and coated and tempered. So it's a very large plant. And I'm very happy.
All right, Mr. Kheruka, we got that. It's that long-awaited commissioning has taken place. Congratulations on that front. But let's talk about a couple of numbers then. Currently, you're doing in the vicinity of around 160 to 170 crores in the standalone business. Now, since you have more than doubled your capacity, when do you hit, say, 300 crores in terms of a revenue potential? Is it by the second half of the next fiscal, towards the end of it? Point number one. And also margins, the going has been tough. From around 30%, it's come down to the mid-20s or so. Give us a margin band. Given that input costs as well have cooled off a little bit, hopefully pricing has stabilized, what could the margin band be? So two-part question, ramp up of revenues and margins. Go ahead, sir.
According to me, the next quarter, which means from April to June, should see doubling of the turnover at least. And there would be attendant improvement in the margin because the fixed cost would be spread over a larger sales volume. So there should be some improvement there. I would not like to hazard a guess. I mean, it would be interesting, the improvement in the margins because of the split up.
So can you tell us raw material prices, both soda ash and natural gas, how are they right now? And do you have any long-term tie-up for gas?
We are working in India with an administered price mechanism for a part of the gas. Fortunately, we have dual fuel furnaces. So to the extent that we get gas at affordable prices, we use gas. For the rest, we are using furnace oil for the time being. So we escape the damage from the high price of gas. Price of furnace oil has not risen that sharply. So we will take by on that.
Right. So in terms of soda ash, I mean, what are the prices like right now and what would the impact be, say, on your margins?
We did extensive covering of soda ash last year. So we have stocks that will last us till perhaps half this year at the older prices. And then we will wait and see whether there is any possibility of softening of prices at all. There might be some softening, but that remains to be seen.
Right. Mr. Kheruka, you said April Q1 of 24 turnover should be double, basically, year on year.
Yeah, we would plan to do that.
Starting. And margins, I remember you said steady state should be between 24 and 26%. That's where things should settle.
You see, the adjusted margin, because in the last quarter that we just saw, the third quarter, we had a one-time gain in exchange rates because the euro had come down to 80 rupees a euro, then it went back to 88. So there's a certain amount of gain there that is reflected in the EBITDA. In my call with investors yesterday, I pointed out that the actual net EBITDA was 22.7% after taking care of those adjustments. So the next quarter, which means from April to June, we should see something better than that, of course. You just mentioned figures of 24 to 26, so that we have to see what that might be.
Okay, just in terms of capacity, one last question from my side.
Yes.
You began by saying we sold everything. That's why imports are coming. I mean, we've basically sold out. Demand is very strong. You indicated about the fourth furnace and some delays there, right? You'd indicated a delay of about 6 months or so. This was back in November. Could you tell us what are the thoughts there? What's the plan?
The thought right now is that we are focusing all energies on stabilizing the existing new furnace that we have.
Yes.
And we have also been working very hard on trying to reduce costs. So there are certain things that we've done which should reduce, which should yield, interesting savings for us as the time goes by. I've not mentioned yet, but we have started a new research and development center in Pune. It's called the BL Kheruka Business Research and Development Center for Borosil. And this is being headed by a gentleman, by a team of 3 people. And the leader of them is an Indian with extensive experience in Japan and Taiwan and 45 patents to his credit. And we expect that this is going to work towards finding new ways and means of reducing our cost of operations.
Okay, all right. Mr. Kheruka, we're running a little short on time, but it seems the street likes what you're talking about. Doubling the standalone revenues, margins could improve as operating leverage plays out. On the European business, if you could tell us quickly, you're looking at replacing the existing 300 tons per day facility with a 500 tons per day facility. What is the total capex for this? When does this come on stream? And will this be better margins?
So actually, there has been a reconsideration of that decision to shut down the 300 and replace it with a 500 ton. We are in fact going in for a rebuild of this furnace, a cold repair. We should start sometime in March, around the second week of March, and continue for around 2 months. The business is doing well. We are very pleased to say that the company's products are very highly rated. There's a very strong demand and very strong consumer acceptance of these products throughout the European Union. And we expect that with capex of about 33 million euros or 34 million euros that is going to be pumped in the next few months, we should see an increase in turnover by about 20% and an improvement in margins also as well because of going in for higher value products.
Okay, all right, Mr. Kheruka, always good speaking to you, sir. Thanks so much for joining in. Wishing you all the best. Hopefully, margins have bottomed out. Revenues as well pick up from here. As we speak, actually, the stock has moved to the high point of the day. Well, let's get in Mitesh Thakkar. Then he's joining in to tell us how do you trade the index. Well, Mitesh, on expected lines, the market's a little bit subdued, but from the lows, we've seen a bit of a bounce. How do you trade the index?
So the idea is that, Nigel, since we have been calling for some kind of a ranged market, I think we are not seeing big directional moves, except yesterday I think was still very positive, but we failed to get past the upper end of the range. So still waiting for that event to happen. Till then, I have one buy and one sell. I think ABB is something, which after numbers was in a good uptrend, had a couple of days of pullback and is now resuming its uptrend. So that's a buy with a stop below 3100, 3095 is what I recommend. And a target of 3220 can be tested on the upside. Very good trend over here. While Britannia, which had a good rally in the last 2 weeks, is now showing signs of a pullback. So that's a sell with a short-term target of roughly around 4475 and stop loss at about 4580.
All right, thanks a lot for that. By the way, Torrent Power is really a big mover right now, 10% higher on that stock, and it's now at just about touching 500 rupees after a good set of numbers. I think the management has liked what Apollo Hospitals had to say. The stock has moved to the high point of trade. The company is saying that they won't see more losses in the digital business and their margin profile will improve as well. So Apollo Hospitals now at the high point.
Stake sale in Said 6 months.
3 months.
3
3 to
months
6
if they
months.
want to do it, but
Yeah.
not in 3 months. But 6 months is, I mean, of course, we pushed early.
Realistic.
We have made quite an impact in the last 30 minutes or so. I think both the managements, the street is reacting to the commentary,
positively.
Borosil as well as Apollo Hospitals.
Hospitals.
Good going, guys.
Okay, good going there. PI Industries, by the way, continues to charge ahead. So lots of stocks with good earnings and positive management commentary today. Let's take a quick break. Manisha Gupta will be here with a quick check on the commodity markets in just a bit. Stay tuned. Welcome back to Bazaar Morning Call. Well, let's get a quick view in on what's happening in the world of commodities. Manisha Gupta is joining in now. Manisha, what are you looking at this morning?
I'm looking at the metals as a sector where we have seen a constant decline coming in. The last couple of weeks have been negative, and this week as well seems to be turning that direction altogether. So it has been a serious pause that you have seen come in for the rally when it comes to base metal prices. As you can see, it's half to 1% decline coming in across board. When you look at the LME index, that was up 10% in the month of Jan, but now it's up just about 3% in 2023 till now. So February clearly has seen some pullback in case of prices here. This is a report card on what the inventories really have done, and this is Shanghai inventories, by the way. So when we started this year, this is the kind of inventories that we had, and as you see, it is more than doubled in Shanghai as of now. Similar is the scenario for LME as well, where you have seen aluminum, copper, zinc and lead inventories, all of that increase. But do not lose sight of the fact that many of these inventories were at multi-year lows or decade lows as well. So the kind of run-up that we have seen, even with this kind of a gain, the inventories on a multi-year levels are still on the weaker side here. So starting on with copper itself, and we did see the inventories decline quite sharply. The last 18 months, when you look at that, the inventory have been at a decade low. Similar is the case for zinc, where we have seen inventories decline to nearly 90-year lows there. Aluminum inventories also have been at around lowest since 2002. So we have seen some bit of a jump up coming in into the markets right now. The increase in Shanghai inventories also tells you that on-ground demand in the markets is not there. Since the time the Lunar New Year holidays hit, we have seen a lot of furnaces and smelting units shut down, and that capacity has not come back in full. And that is the reason you have seen these inventories continue to be on the higher side on a month-on-month basis. But on a year-on-year basis, we still are much on the weaker side here. Another chart to tell you on where we are in sense of prices as well. As I told you that the LME index has given up nearly 7% of its gain in the month of Feb. This is what the prices have done. On 1st of Jan, when you look at copper, we were trading at 3.76. By the end of January, we saw a good gain, 12% of a jump up. But from those kind of highs, it has been some profit taking that we've seen in the month of Feb as well. Same is the case for aluminum as well. $2,311 per ton is where we started. We saw nearly $300 of a jump up, and from those kind of levels, we've given up $200 already. Zinc as well should come in on your screens. We started the year with 3,000, went to 3,400. We are trading at 3,100 right now. So from its highs, most of these metals have given up anywhere between 8 to 10% as we trade in Feb.
Okay, thanks a lot for that. The big mover in the broader markets is Torrent Power. It's now up almost 10%. If you're wondering why, Vivek is here to give us the lowdown. Vivek, over to you.
Well, absolutely right. It's been a very strong set by the company. There's been broad-based growth across most of the verticals, like you mentioned. So profitability is higher by almost 86% on a year-on-year basis, and margins too, despite that, has come in quite strong at 22.4% against 24.8% last time around. What is it that has led to the strong growth? In fact, there was a gas trading gain of close to 400 crore in this particular quarter that aided the bottom line. And when you're talking about the growth seen, the EBITDA contribution came in from all of the segments. So gas-based power trading business, the renewables business, the distribution license, as well as the franchisee business, all of them aided. In fact, HDFC Securities has come out with a note. What they're saying is that, it's been a good set of results by the company. Sturdy gain from the LNG trading has actually aided the profitability. Also, there has been some significant positive news coming in as far as reduction in the franchisee, T&D losses. Again, this is something that they're seeing quite positively. Increased contribution from the existing distribution circles as well as the newer circle of Dadra and Nagar Haveli. And what they're saying is that the LNG business should continue to do quite well. The only setback is the underutilized, gas-based power plants that the company still has. That's the only drawback, but otherwise a very strong set of results from Torrent Power this time around.
Okay, thanks a lot for that. Well, the other stock that we're looking at this morning is Bharat Forge. Now, brokerages are cautious post the earnings that have come through for Bharat Forge, and hence the stock is down 6%. Nomura has downgraded the stock to a neutral. Their target price is still higher at about 992 rupees, but they say that there is a cyclical slowdown in the traditional businesses. This will be offset by a good growth in defense, in the non-auto business as well. But the biggest pain point for Bharat Forge is the overseas subsidiaries continue to see losses, and that's a big drag. The stock is also trading at around 14 times FY25 EV to EBITDA. The valuations are fair, is what Nomura believes. Citi has a sell with a target price of 690 rupees. They say that the disappointment on the overseas subsidiaries continues. The losses have expanded quarter on quarter, but the management is optimistic. They say that there are multiple tailwinds for revenue and profit growth in FY24. But cautious views coming in on Bharat Forge. The stock is down almost 6%. Let's slip into a quick break. On the other side, it's our special segment. It's the economy. Lata will connect with Samiran Chakraborty, the Chief Economist India at Citi, Girish Kousgi, the MD and CEO of PNB Housing Finance, and Sandeep Runwal, the MD of Runwal, to decode the CPI data for the month of January. That was a shocker this time around. Stay tuned for more.